I want to hear from Jeffrey Gundlach, DoubleLine, of course, who joins us exclusively now on Closing Bell from the ETF Exchange Conference in Miami with our very own Bob Pisani. And Bob, what a day to have Jeffrey Gundlach with us today. Take it away.
And Scotty, it is a big day, of course. Jeff joins us here speaking, of course, at the ETF Exchange Conference. Jeff, you just addressed 1,000 people in the audience. Your basic message today, interest rates have bottomed. I want to talk about CPI, but get to that message right now. Interest rates have bottomed. What's the implications for that for investors?
Well, interest rates have very long cycles historically. For whatever reason, they tend to move in a broad trend for about 40 years. And we all know that interest rates kind of rolled over at very high levels a little over 40 years ago. And now interest rates are up over the last couple of years. So it's almost exactly 40 years. And I just think that interest rates were absurdly low, particularly real interest rates. And now real interest rates are reasonable. But I think that we have a problem with the amount of money we need to borrow. And that will cause a strange movement that we're all used to thinking that the economy gets soft and interest rates are taken way down by the Fed, and long-term interest rates also go down by a couple hundred basis points at least. But I got a feeling that when the economy weakens enough so that the Fed really does cut in earnest, I think we're going to be having a real big problem with people understanding how much debt expense we have. And they might start thinking that longer-term interest rates need to be at, well, they were 10% real yields in 1984. So it's not at all implausible that interest rates could go up into the high single digits, and it's part of this long-term trend. Now, one thing, I think that the economy is more vulnerable under a rising interest rate regime than it is under a falling interest rate regime. Under a falling interest rate regime, companies that are in trouble and maybe marginal credits, even though they might have to pay more on a spread basis, they're paying lower interest rates. So they can refinance and take money out and reduce their interest expense. That prevents defaults. That supports all of the risk assets. They're reliant upon financing of marginal companies. But when interest rates are rising, maybe they'll have to default. So maybe it adds volatility to the economic cycle. And certainly that was the case when interest rates were rising in the 70s and 80s. There was tremendous economic volatility. So I think interest rate volatility and higher interest rates as a theme create more vulnerable markets.
Scott was mentioning it's a big day to have you on. January CPI was hotter than expected on almost every level. Yeah. How does this play into the expectation for interest rate cuts? The market was expecting 6. Where are you at, and how does this data today change those expectations?
I think the market has had tremendously overpriced the amount of cuts this year. It was down to almost a certainty of 6. And it seemed that the Fed, since they weren't going to move in March, per the words of the chairman, that means they're getting started in May. And then there's this thing called the election that I don't know if they probably aren't primarily focused on that, but to have 6 rate cuts between May and the end of the year always seemed like a lot to me, absent some very substantial improvement in inflationary data, which did not happen today.
Does the Fed care about elections? I mean, Jay Powell, if he was sitting here, would say, we don't make decisions based upon elections. Is that real, or is the Fed actually influenced by elections?
I think they don't want to be blamed for anything. So weirdly, it doesn't matter if they intend to be political, even if on a secondary variable, which is where I would place it. They care about the optics of things, and they would prefer, all things being equal, to be a little bit less aggressive, I think, in an economy like this. Now, the CPI today, it's funny how the inflation discussion has changed over the past year and a half or so. We went from it was going to be this super core PCE was going to be the inflation metric, and that was rolled out of Jackson Hole, I think it was, in 2022. And they don't talk about that at all anymore. But instead, back in November, when it seemed like they had a radical change in tone on November 1st, it seemed like all of a sudden we were talking about picking and choosing different inflation indicators and not focusing exclusively on year over year, but doing things like 6-month annualized, 3-month annualized. And today's report came back to bite them on this, because the 3-month annualized core CPI is going up now.
It's 4%.
It's 4%. The 12-month number is 3.9. So it's no longer, well, we can look at the 3-month annualized and take comfort, because that's what's really the trend is, and maybe it'll stick, because it's not sticking anymore. Yeah. It's going up. So what really matters, though, is not the CPI, although it's important. It's the PCE. That comes out on the 29th. And we have PPI coming out, I think on Friday, if I'm right. And that will give us a pretty good idea of what PCE is. If PCE cannot go up and have the Fed talking about cutting interest rates.
And we've all been trying to figure out what's the leading indicator to look for here. And you had a fascinating discussion here at this conference about the 2-year Treasury as the leading indicator. We tend to think the Fed leads the 2-year and moves things around. And your position was it's actually not true. It's the 2-year that leads the Fed around. So right. What is the 2-year? The 2-year is telling us right now.
The 2-year is sort of telling you that you're going to get about 100 basis points of cuts on average over that 2-year period. So, it means that you're going to see that the Fed should cut interest rates. If they're going to do it this year, should probably be about 50 basis points.
Let me ask about the stock market. 20 times forward earnings on the S&P. Are you concerned about the valuations? Yeah. There's a whole discussion here about the Magnificent Seven. The investment advisors are very worried about concentration risk. They're worried their clients are telling them, buy NVIDIA, and it's too risky to have too much concentration. Are you worried about that concentration? Does it bother you that it's such an important part of the S&P 500 now?
It does. I think these concentrated technology, this is going to be the future and it's going to take over the world type of talk has happened repeatedly. And the forward earnings thing kind of bothers me. They're looking for 11 or 12% earnings growth. Last year, they were looking for 11%. It came out at 1%. So with the Fed rate cuts being pared back in terms of expectations, thanks to the CPI data, and the earnings being suspect, what's predicted, in my opinion, I have a hard time. I have a hard time with basic passive market-weighted investment. I really prefer equal-weighted at this point.
I want to bring in Scott Wapner, my colleague. He's got a couple of questions. Scott.
Hey, Jeffrey, I appreciate you so very much being with us today, especially given what's happening in the markets. Do you think that the Fed's own calculus changes as a result of one CPI report?
No, I don't. It's disappointing to them, I'm sure, because there was tremendous hope that this gentle decline was going to continue. But this one cannot. The shelter numbers look weird. The OER number looks weird. It's 6% year over year. And for all I can see, rents aren't growing at that level. Home prices aren't growing at that level. And the indices like apartment rent and the Zillow indices, they lead the OER very, very convincingly by about a year to 18 months. And they've fallen tremendously, those indices. So this shelter number is really an outlier relative to kind of the trend and what we expect from these relationships. So certainly not one number with this odd type of shelter reading is going to make that big of a difference. But the PCE number is going to be super important. And then I think then the next month numbers, people will be sort of on pins and needles. But the market has priced out pretty much a May rate hike at this point. So now the idea that you're going to get, more than 2 or 3 rate hikes as a base case is kind of hard to pencil out.
They haven't fully priced it out, of course. I mean, the probabilities of May have come down. Do you think May is the starting gate?
Doesn't look like it to me. It could be. I mean, there's enough data coming up between now and then, but it's probably going to be June if it happens at all. But our inflation model is such that absent a spike in oil, which has had every reason to spike, right? Every excuse with Ukraine and the Red Sea and all that, and it hasn't. But if it stays where it is, then we think inflation on the CPI will relax, and this will be something of a blip, particularly on the headline number, and it'll go down to about 2.5%. One thing that I'm using as a leading indicator, and I have been, are commodity prices. Broadly, the Bloomberg Commodity Price Index has been below its 200-day moving average for a long time now, and it can't seem to get above it, and it just keeps falling. And that's further corroboration of relaxing inflation, but also of weak global growth and weak global demand for these commodities.
You know, there's another pretty big debate, I think, in the market. Liz Young alluded to it in the lead up to welcoming you onto the program. It's whether the economy can remain this strong and have inflation go down towards 2% at the same time, or if one causes too much demand that keeps inflation elevated. How would you address that? Because it appears as though the initial calculus of that by the Fed itself has changed, in that you can still have a strong economy with solid growth and still have inflation come down because it was caused by things around the pandemic more so than excess demand.
Well, you know, I suppose that's possible. I am skeptical of, the last man standing in the economy is always the last man standing, and it's the unemployment rate and some of the employment data. And I know that the last report was very strong. There's some weird seasonals, but that doesn't account for the strength. And I just think that there's other employment data that leads much more than the U3 employment rate, which is really a coincident indicator. And that's things like hours, the work week, which is collapsing. It's sort of like temporary jobs, which are shrinking. A lot of these leading indicators don't share that type of strength. And I talked about this last time I was on with you, Scott. 88% of states, and the states report employment data as well, 88% of the states say unemployment is rising over the last 6 months. And those states that don't have rising unemployment include Wyoming. There's about 5 or 6 of them. Wyoming, North Dakota. Okay, they might be adding jobs, but that's not a very big population base to carry the other 88%. And the states that have rising unemployment include California, Florida, Illinois, New York, New Jersey. I think you can see what I'm driving at here. It seems very weird mathematically, just arithmetically, that these two unemployment source sets could have such disparate readings and implications. So I don't know. I hear this type of talk. Now it's soft landing. That used to be, years ago, we called it Goldilocks. In 1999, they called it Nirvana. And whenever I go anywhere now, people are asking about this Nirvana situation. And that puts my radar up, because that becomes sort of a, you know, everyone sort of agrees on something that maybe they need to think through a little more carefully. You know, at this conference, Bob pointed out when we were on stage that these types of conferences historically would always have sections on international investing, international equities, and weirdly, this one doesn't have a single one. To my eye, that says something is happening in the zeitgeist that needs to be faded, that you need to think, maybe I don't just want to nod in a north-south direction just because everybody else is doing it. So that's kind of where I am. I think this is a tell that international investing needs a closer look. And as you know, Scott, I've always recommended India, and I'm more bullish than ever.
I was surprised at your comment on your recommendation on allocation, because the investment advisors here want to know, what are you recommending right now? I was surprised how conservative you are. 40% bonds, 25% cash, 10% real assets. I guess the rest stocks. That's a pretty conservative portfolio.
I think, if you ask me, you know, I'll give you slightly different answers on the hour of the day that you ask me these things, because the markets move. But I could see having 30% in stocks, frankly, and I would have 10 in Japan, 10 in India, and 10 in an equal weighted U.S.
10 in an equal weight U.S., not a market cap.
Not market cap. I don't want market cap.
Literally 10% of the asset allocation is just in the U.S. on an equal weighting. That's it. Because U.S. is too overvalued. Why so conservative?
Well, normally I might say 35% U.S., but I got 25 of it in cash because I want to buy stuff cheaper, and I think you're going to get cheaper at some point along the line of 2024. So I want to be ready for that.
All right. Jeff Gundlach, always a pleasure chatting with you. We didn't even get into a long discussion on deficits and Social Security. He has ideas on solving Social Security too, Scott. We got to get him back and get his ideas on how to solve that next big problem.
Yeah, we will.
Jeff, thanks very much. Always a pleasure.
Thanks, Bob. Thanks, Judge. Talk to you, what is it? We got March coming up.
Yeah, we certainly do. We have another meeting coming up, which means we have another conversation in the wings too. Jeffrey, thank you. Bob, of course, thanks to you as well.